It's a great pleasure to be here with all of you at the Sorensen Impact Summit to talk about the way forward for impact investment and impact economies. We live at a historic moment, a moment when there are three massive forces that are coming together to increase hugely our ability to deliver impact. The first is a massive change in values and preferences. It started with consumers 10 or 15 years ago when they refused to purchase the products of certain companies that were doing harm environmentally or socially. It was followed by talent refusing to work for these companies, and the combination of those two changes led investors to realize that there were serious consequences for the value of their investments. And so today we see investors channeling $30 to $40 trillion, about half of all professionally managed assets, in the direction of ESG investment, environmental, social, and governance investment, where there is an intention to generate impact as well as profit, but no measurement of the impact created, so far at least. And impact investment itself, where you do measure the impact created, in all probability hit its $1 trillion mark in 2020. And 6 years ago, when we published the report of the G8 task force, and we had a chapter heading, the first trillion of impact investment, people thought we were crazy. And here we've done it in just 6 years. So these massive changes of values have led to a massive change in investment flows. The second big trend is the technological leaps that we have been able to take in recent years, which have brought us to artificial intelligence, to machine learning, to augmented reality, and many more technologies that enable us to deliver impact globally in ways humanity could never contemplate up until now. And finally, these technological breakthroughs enable us to measure the impacts of companies in a granular way. They enable us to measure the environmental impact from a company's operations, the employment impact it creates, and also the product impact on people and planet that it delivers. The combination of these three trends is what is bringing the impact revolution into being. The impact revolution follows the tech revolution, which has preceded it, and as I have been saying, builds on the tech revolution's achievements. But what started off looking like a new way of investing, the initial development of securities like social impact bonds and development impact bonds, outcomes funds to pay for the results achieved from these impact bonds, seemed to be ways of connecting those who want to improve the world to the capital markets. But today, we realize that they actually optimize risk, return, and impact. And that by doing so, they put us on the path to impact economies, where investors and companies optimize risk, return, and impact, so that our system, instead of delivering as it does today, damage to people and planet as companies pursue profit without regard to the consequences, to economies that actually generate solutions to these great challenges alongside government. And I want to give you a peep into the future, because what is going to drive this revolution forward over the next 2 or 3 years is increased transparency on the impacts that companies create. Now, I have been privileged to chair an effort at the Harvard Business School called the Impact Weighted Accounts Initiative. It's a joint initiative of the Global Steering Group for Impact Investment, which I chair, and which today covers 33 countries, and in which Jim Sorensen has been very much involved, and the Impact Management Project, which brings together more than 1,000 different people and entities involved in impact measurement. We've published on the Harvard Business School site, you can just look for impact weighted accounts, the environmental impacts of 1,800 companies in monetary terms. And when you look at the figures that have emerged, the mind boggles. You see that 250 companies out of the 1,800 actually create more environmental damage in a year in dollar terms than they do profit. That a third of them, 600, create environmental damage equivalent to 25% or more of their profit. And that taken together, the 1,800 companies create $3 trillion worth of damage in a single year. And just as interestingly, when you look at the valuations of the companies that appear in this data set, you realize that within several sectors where impact information has actually flowed, that there is a correlation between companies that pollute more and lower stock market valuations. In other words, the $30 to $40 trillion of ESG money has actually tilted the scales in favor of companies that deliver both profit and impact. Now, when you add to environmental impact, employment impact, and we're about to publish the employment impact of 3,000 companies or so, you begin to get another peep into the future. You are able to measure the demographics within and outside a company's facilities, to make comparisons in the diversity that exists between the two, and to attribute remuneration levels to missing representatives of minority or gender groups. And the figures, again, make the mind focus, let's say, in this case, on the issue of diversity. Because if you look at a company like Apple, which has a $10 billion wage bill in the United States, all of which, in theory, should be positive employment impact, but you measure these differences in diversity, in advancement, and in pay, you begin to realize that there is a $2.7 billion charge against the positive employment impact of Apple. And when you compare it with Costco, which employs twice as many people, 160,000 in the US, the charge is $1 billion, because Costco is more diverse. And we will be publishing later in the first half of this year, by the end of the month of June, I very much hope, the product impacts of several hundred companies spread across 11 different sectors. And so we have really taken, because of technology, a major step forward in measuring the impact of companies in a similar way that we measure their profit. And this has very deep implications, not just for investors, but for companies. It's effectively shifting the goalposts for businesses from just making money to making money and delivering impact. And if a few years ago there was a feeling that somehow optimizing risk, return, and impact was going to result in necessarily lower financial returns, that myth is being exploded. In fact, as I say in my book, Impact, there's plenty of evidence to show that if you optimize risk, return, and impact, you can actually deliver better financial returns than if you just deliver risk and return optimization. Now, why would that be, you'll ask? Well, one reason is that it's easier to attract customers and talent and investors. That's what they're all looking for today. Profit and impact at the same time. But another one, which is coming into much clearer focus now, is the risk of higher taxation and regulation for companies that are heavy polluters or heavy creators of social issues. And so it's not surprising that you should be able to deliver higher returns. A good example of what is going to be happening increasingly frequently as the disruption from impact mirrors the disruption that technology started to bring when I started my career in venture capital 50 years ago. The changes that impact is going to bring are similar to those that we're beginning to see companies like Tesla bringing to the automobile industry. Tesla didn't enter the automobile industry because it was an easy industry for it to enter. It was a very competitive, old, established industry. It entered it because it wanted to shift the industry away from the automobile industry, from the combustion engine, forgive me. It wanted to shift the industry away from the combustion engine and so reduce the damage to the environment that automobiles bring. And it has succeeded in doing so and creating huge value for its shareholders. Its share price has multiplied 7 times in 1 year only, in 2020. And it's worth 5 of its competitors being, put together. And so that is what I think the future is going to be made of. Entrepreneurs coming with disruptive models that introduce impact alongside profit and begin to disrupt industries where the entrenched leaders don't see impact coming in the way that some entrenched leaders didn't see technology coming and are overtaken by new entrants. The key in achieving this is transparency on the impacts of companies. Now you might ask, well, how are we going to get to that? Well, the answer to that is because investors today, whether they're investing their money directly or whether they're managing it, having it managed through asset managers, or whether they're pension savers, are beginning to put pressure on the decisions that their managers are making for them. That's leading to the biggest investment groups becoming increasingly vocal about the need for impact transparency. We saw just a few weeks ago at the Procter & Gamble shareholder meeting, 2/3 of shareholders rebel against the management of P&G. Because of what? Because of the deforestation that P&G was causing through its use of palm oil. We can expect to see more shareholder rebellions, and not just around environmental issues, but around social issues like diversity and gender equality too. And to the extent that investors ask for impact information and are able to get it, but not every investor has the same ability to do that, which is what is happening now. To the extent that we can see this information to be price sensitive in terms of the valuations of companies, regulators are going to have to step in. They're going to have to step in and make sure that all investors get consistent and comparable, reliable information at the same time about impact. And we see that happening now. IOSCO, which groups all of the world's regulators together, is pouring exactly on this issue. And we've seen the declarations of the Roundtable about 18 months ago about a shift to stakeholder capitalism. Well, the shift is going to come because of transparency on impact. And I want to close by just saying humanity has been there before. What do I mean by that? Well, after the crash of 1929, investors realized that they had been investing in companies without understanding their profitability. Every company in those years could pick its own accounting principles, and there were no auditors to verify the figures. The Roosevelt administration introduced GAAP accounting and the use of auditors, and the whole world followed. The legislation came in 4 years after the Great Crash in 1933, and then in 1934. And it took a few years after that for GAAP to become introduced. We are at a similar crossroad today with regards to transparency on the impact of companies. And if the Biden administration or the EU or other governments across the world respond to this crisis through a bold step that's designed to bring companies and investors alongside them to meet the great challenges we face at a time when they are heavily laden with debt, then the impact revolution will have come.